Hello, everyone. Welcome to the lecture on portfolio management. So in this video, we're going to briefly introduce portfolio management, the mathematical construct, and a few extensions. So what is portfolio management? So portfolio management is a systematic management of a collection, right? Several financial instruments. It could be the stocks, it could be the bonds, or other financial derivatives. And they are going to be put together to reach a certain goal. The goal is really twofold. One is the return of the portfolio, and one is the risk. Right. So later we're going to talk about how they are being defined exactly. There are two types of portfolio management. One is active management, trying to change the allocation of the portfolio weights for each asset and trying to beat the market, right? To be more proactive. The second type is passive management, meaning we're going to track certain index and trying to follow the market, right, without trying to beat it. So there are a few mathematical frameworks derived based on portfolio management. First one is the modern portfolio theory, so which is not so modern. It was proposed in the 1950s, but still is called modern portfolio theory, MPT. And relatedly, a very relevant and the framework is called capital asset pricing model, which is directly based on the MPT framework. And later, this was also extended to multiple factor models. So portfolio theory is a framework that seeks two things, risk and return. And these two things are sort of a trade-off, and they can sort of be arranged in two ways. So first we can seek the highest return, which is in expectation, right? The expected return, we want to maximize subject to certain risk, right? So we want to control the level of risk exposed for the portfolio. Alternatively, we can frame the problem as we want to minimize the portfolio risk, right? Given a certain level of expected return. So we say that the overall return should be above some minimum threshold, and given that happens, we want to minimize the risk. So this really concerns two things. One is portfolio expected return, and one is the portfolio risk, or sometimes, or more often, we call it volatility. And we're also going to talk a bit about diversification, the benefit of diversification, the resulting efficient frontier, the risk-free rate, and the mathematical framework. So let's look at the portfolio expected return. So imagine that we have a portfolio of assets indexed by I, and in total we have n assets. So we denote the asset return as a random variable, right? So we usually model the asset return as a random variable, and this I really says that this the return as a random variable for asset I. And recall that this is calculated by merely as a percentage return. So I have the stock price for today, assuming it's a stock, and this is a price for yesterday. So we take the division based on yesterday's price. We have the return as a realization for that day, for day T, for asset I. And we can collect many returns as a random variables in the portfolio, and we put it in this bolded R variable, random variable. Right. So this is a random variable that represents the collection of individual assets. So we can take so for each individual asset, we can take the expected return just by taking the expectation, right? So this is the expected return for each individual asset, and this will serve as the estimate for future return. Right? So we take the expected return as the mean, as the average. So we can do this for all the n assets in the portfolio. We have this bolded mu. Right, this represents the collection of expected returns for each individual asset in the portfolio. Right, so this is the vector we have, and we need another vector to represent the desired allocation, right, for each individual asset. So we call this W. Right, so each W represents the weight allocated for each individual asset. So usually we can constrain them to sum to 1. So and each of them will be positive. So meaning this can be 10%, 20%, etc. And then they should sum to 1, and they should all be positive. we call it non-negativity constraint. Right, so this is another vector. So I have two vectors, and then these two vectors, when we multiply them together, right, this is the dot product. This will be the total overall portfolio return. So this is a single number that represents the expected return at the portfolio level, right? So if you expand it, right, so it's going to be each individual assets allocation percentage times the return for that asset, and then we do this across all the assets and then add them together. So this will be our portfolio expected return. So next we have the portfolio risk or volatility. So for each individual asset, we can calculate the variance of that particular asset, right? So remember, this is random variable. We're calculating the random variable, and we're calculating the variance of the random variable, which by definition is the expected squared deviation between the random variable and the mean, right? So this is the individual mean or expected return, right? So this is the definition of the variance. And of course, it's the same across multiple individual assets. So now let's look at slightly more involved. So what if it's two assets, right? So how do we calculate the variance or also called covariance of two assets? So by definition, this is defined as the expected deviation, right? But deviation is between the random variable and their individual mean, and we multiply them together. So this is a cross product, and then this is measuring the covariance between two random variables. All right, so now if we aggregate it one level up, we have a total of n assets. Then at this portfolio level, how do we calculate the variance? So the variance is calculated based on this formula. So again, because it's variance is squared unit, we need to time this W twice, right? That's W squared in the scalar case. And then this Q is our portfolio, the covariance matrix, right? This is covariance matrix calculated based on the total of n assets. And if we expand it, right? If we expand it, then this will look like this. So meaning to say, we have this. So let's say we take asset I and asset J, right? We can calculate their respective covariance. So this is definition is basically given here. And we multiply their corresponding weights, right? Wi and Wj. And once you do this, this is just for asset 1, asset J. We need to iterate across all the different assets, right? So including the asset itself. So meaning I will go from I to N, J will go from I to N. And it may be the case that I and J may be the same. So in that case, it's just the variance of the asset itself, right? So specifically, if you look at the calculation this way, then the formula for expression for the variance of the portfolio is just the sum of individual variance scaled by this W, right? So this is the diagonal, the sum of diagonal elements, right, of the covariance matrices of this covariance matrix, and then we have the off diagonal sum. So meaning I goes from I to N, but then J will also go from I to N, but J is not equal to I, meaning we are summing across all the off diagonal elements. Right, so this is essentially a breakdown of the total covariance calculation, and equivalently you can express it as again the summation by writing this covariance term as sigma I times sigma J times rho Ij. So rho is the correlation between asset I and asset J. So if we look at the definition of the correlation, it's going to be defined as covariance, right, scaled by the individual standard deviations, right? So this is just another way to write the same thing. So if you look at the portfolio level risk or volatility, that is going to be taking the square root of the variance of the portfolio. Okay, so now let's look at diversification. So there's something called free lunch, right? And this is the only free lunch in finance, and that is called diversification. So specifically, when we aggregate, right, when we put together a collection of assets in the portfolio, then it will lead to reduced risk, right? The variance will be lower. And this comes without sacrificing the expected return. So what this means is that if you look at the expression for the portfolio return, now this is what it is, right? So we talk about it. There's no magic here. The real magic comes from the portfolio variance, which is again defined in this way. And this means that it's going to be less than, right? It's going to be less than the sum of individual variances, right? The sum of individual the individual variance, of course, to square it to bring it back up to the variance level. So what it means is that if we were to put together a collection of assets, the total aggregate portfolio variance is going to be smaller than if we were to add their individual variances together, right? So this is what I'm trying to say. And this is really the magic. And that's the key reason is because essentially of the correlation factor, which by definition is going to be less than equal to 1, right? Usually it's at 1 because it's very difficult to find not two assets with correlation equal to 1. All right, so this is the free lunch we get by putting together a collection of assets which are less correlated or sometimes even uncorrelated or negatively correlated. So now let's look at the mathematical formulation of MPT. So as I mentioned, there are two ways to formulate the problem. The first way is to say, I want to maximize the portfolio return, right, in expectation. So this is expected return. Remember, this is expected return. And this portfolio return subject to a constraint on the portfolio variance. So the variance is defined as by threshold. So this is user-defined target variance. So as long as it satisfies this constraint, and I want to maximize the weight such that the portfolio return is maximized. And usually we come up with this additional constraint. So one is the budget constraint, meaning we cannot really go beyond this, go beyond what we have, right? So we have to allocate what we have, and then it should sum to 1. And also we cannot short sell. So meaning it should be all positive. It should be all positive in terms of individual assets Ws. Now, equivalently, we can also frame the problem as we want to minimize the portfolio variance, right? So this is objective, subject to certain constraints on the expected return. So now this should be above some certain user-defined target, right? So this is another way to look at it. And again, we have the budget constraints and also the non-activity constraint. So if we do this, right, if we run the portfolio procedure, optimization procedure, we will get this efficient frontier. So essentially, imagine that you have a collection of assets and you're given certain constraints and objective and a run, and the result will be optimal set of weights, right? So the weights will correspond to the corresponding expected return for the portfolio and the corresponding portfolio variance, right? So if we take this optimum variance, right, the optimum volatility, right, and technical volatility, and then the expected return, and plot that on this coordinate system, then we have this curve. So what this means is that if we look at the this point, what this point represents is that if we draw this vertical line here, this point represents for a given risk or volatility at the portfolio level. This is really the best point we can get, right? So in terms of the target return, so this is the best return we can get, and this is corresponding to maximizing the expected return subject to a certain constraint on the risk. So alternatively, we can look at in this horizontal, so if it does a horizontal cut, this point represents the portfolio that minimizes, right? So there's a lot of combination here, but this point is the portfolio allocation that minimizes the risk subject to a constraint on the portfolio return. So that's really two ways to look at it. There's a relevance objective framework, which is to maximize the Sharpe ratio, right? The Sharpe ratio is defined as the expected return, right? So this is called the excess return. So meaning the expected return of the portfolio minus the risk-free risk. And again, we scale it by the portfolio risk, portfolio volatility, right? So we want to maximize this quantity instead. And we have, again, the same constraints here. So if we do that, then this is what we call an optimum portfolio by maximizing the Sharpe ratio. And it's going to be, again, a point along this efficient frontier. It's going to be somewhere around here, right? That's it. So this point represents the point where we have the maximum Sharpe ratio. So a related framework is called the capital asset pricing model, CAPM. So this, okay, that's should change here. So it's going to call CAPM. So it's essentially a linear regression model, right? Which again is by nature is going to be a one factor model. So this one factor is what we call market factor, right? So specifically, if we model the portfolio, right, as a random variable, and this is expected return of the portfolio, and this is excess return, right? So it's offset by the market risk-free rate. So we're going to model this variable as a linear regression in an regression framework against independent variable. So this is what we call the market factor or market risk premium, right? So essentially we have this market random variable to represent the market return, and then this is the excess return, and we have these coefficients alpha and beta, right? So this is in essence a linear regression model, and there's different interpretations for the different parameters. So alpha measures the risk-adjusted performance of the portfolio manager. So if I'm portfolio manager and I manage a portfolio, and if I run this, right, if I run this regression and get alpha, so if the alpha is positive, then we say that the portfolio manager outperforms the market, right, outperforms market. But if it's negative, then it means that I'm doing worse than the market portfolio. So this is really a very indicative metric in terms of the performance of portfolio manager, right? And then what about the beta here? So beta measures the sensitivity, right? So the sensitivity of this quantity against this quantity. So essentially it's the slope, right? It's the gradient. So it measures the sensitivity of the asset return to the overall market return, and it's defined by this expression. So we have the covariance between the portfolio and the market, and also scaled by the variance of the market, right? So this is by definition. And we can derive it from the first order condition. So assume that we have this framework, and then want to trying to minimize the summer square error in the linear regression framework, and then we'll calculate, and then we'll be able to get the expression for the beta here, right? So epsilon is again all the information we cannot model, right? So all this idiosyncratic signal that's not explained by the market, we're going to the noise term, right? So now if we add the risk-free assets, right? So previously we mentioned that the efficient frontier assumes we have a collection of assets, and all assets are risky, right? Because there's a randomness. If there's a randomness, then there's a risk. Now assume that we add one more asset, which is risk-free asset, and could be, for example, treasury bills, right? So there's no risk, and there's a sort of guaranteed return, we denote as a RF, right? That RF. And the setting is that we allow for negative weight for the risk-free risk assets, right? So meaning we can short it, right? Can borrow money from the bank. So if we do this, then we have essentially enlarged our portfolio with one more asset, which is risk-free. Now, if we do that, that can draw a new efficient frontier, right, based on the original frontier, and we call this capital allocation line. So essentially, it's going to be a straight line, right? And then we call this capital allocation line. So, so if we were to write out the portfolio risk and return now, now the portfolio risk will be a weighted sum between these two guys, right? Because this represents my risky assets, right? We call this risky portfolio or market portfolio, right? This is our market portfolio, and this is the risk-free expected return. So this is essentially a weighted sum. So that's no surprise here. The portfolio variance is still the variance based on the risky portfolio, and the reason is because the risk-free asset itself has no variance, right? Has no variance. Therefore, we just write it as the same as the market portfolio, right? So if we combine these two terms, and then we have you can express the expected return of the portfolio as a function of in this form. So we have the risk-free rates, right? And then we have the this quantity, and then we have the volatility of the portfolio. So if we map this expression, remember that this is one quantity that's changing, right? This is another quantity that's changing based on the x and y axis. So again, x-axis would be our sigma p, right? This is portfolio volatility. This measures portfolio risk, and this looks like a line, right? So we draw this line, and then of course the intercept would be RF along the y-axis, and then we have the slope, right? This is our slope. So if we to draw this line will be called the capital market line, CML, right? And this, we can explain this line by maximizing this term here, which corresponds to the Sharpe ratio, right? We're trying to maximize the Sharpe ratio earlier, and if we do that, then we have essentially maximizing the Sharpe ratio. So if we do that, then we reach this point. Again, this is the point representing the maximum Sharpe ratio of the risky portfolio, and we also have this. This if we were to cross it, right? This risk-free rate, and then if we draw a line in between, this line is our efficient frontier, right? It's our live efficient frontier. If we have one more additional risk-free asset, right? So any point, right? Any point on this line is called market equilibrium, right? So we reach market equilibrium if we're at end of this points of the capital market line here. All right, so that's it. A brief introduction of the background and the fundamentals of portfolio management. And thanks for watching.